In today's fast-paced financial environment, effective retirement planning is more critical than ever. One of the predominant tools available for employees to save for retirement is the 401k plan. However, managing a 401k plan involves a range of responsibilities, particularly for fiduciaries. This course covers the role of a 401k fiduciary, outlining their duties, legal obligations, and the overarching importance of maintaining a commitment to plan participants. A fiduciary is defined as an individual or organization that has the legal and ethical obligation to act in the best interest of another party. A person is a 401k plan fiduciary to the extent that he or she exercises discretionary control or authority over plan management, or authority or control over management or disposition of plan assets, renders investment advice regarding plan assets for a fee, or has discretionary authority or responsibility in plan administration. In the context of a 401k plan, fiduciaries can include various stakeholders, employers, plan sponsors, trustees, and sometimes financial advisors or third-party administrators. The foundation of fiduciary duty in retirement plans is primarily established by the Employee Retirement Income Security Act of 1974, ERISA, which imposes strict standards on fiduciaries concerning how they manage employee benefit plans. There are three distinct types of activities associated with 401k plans. Fiduciary functions. Fiduciary functions involve activities that confer fiduciary status. These include serving as a plan sponsor, appointing other plan fiduciaries, selecting and monitoring investment options, choosing and overseeing third-party service providers, interpreting plan provisions, and carrying out similar responsibilities. Administrative functions. Administrative functions are purely administrative and do not establish fiduciary status. These tasks might include preparing communication materials for employees, maintaining participants' service and employment records, preparing reports required by government agencies, and collecting and applying contributions. Settlor functions. Settlor functions involve business decisions regarding the plan that are not subject to ERISA's fiduciary standards. This includes such activities as establishing a plan, amending or terminating a plan, and determining which benefits to offer. It is important to note that the same individual or entity may perform fiduciary, administrative, and settlor functions. During committee meetings, it is advisable to discuss these different functions separately and clearly label them in the agenda and minutes for transparency and clarity. Understanding the responsibilities of fiduciaries begins with ERISA, as it sets the standard for the management of retirement plans in the United States. ERISA's primary goal is to protect the interests of employee benefit plan participants and their beneficiaries. Under ERISA, fiduciaries have several critical duties. Duty of prudence. Fiduciaries are responsible for the proper management and safeguarding of plan assets. Prudential management requires executing duties with the same care, skill, prudence, and diligence as a knowledgeable person would when handling similar matters. One of the most critical responsibilities is making prudent investment decisions. Fiduciaries must conduct due diligence when selecting investment options. This includes analyzing the historical performance of investments, the financial stability of funds, and market conditions. Prudent fiduciaries consistently assess whether the selected investments align with the risk tolerance and long-term objectives of plan participants. Fiduciaries must thoroughly document the reasoning behind every decision. The responsibility of prudence does not end with the selection of investment options. Continuous monitoring and periodic reviews of the plan's investments are essential. Fiduciaries must stay abreast of performance metrics and adjust the investment options as needed. Regular reviews can include analyzing investment performance against benchmarks and conducting assessments of the adequacy of service providers. In some cases, specific regulations provide guidance for fiduciaries. For instance, if your plan allows for employee contributions through salary deductions, you are required to deposit these contributions as soon as reasonably possible, but no later than the 15th business day of the month following the payday. If you can make the deposit sooner, it is your obligation to do so. The obligation to act prudently encompasses a broad array of functions essential for operating a plan. Given the extensive nature of these responsibilities, it is often advisable to consult with experts in areas such as investments and accounting. Duty of loyalty. This duty mandates that fiduciaries must act solely in the interest of plan participants and beneficiaries, not allowing personal interests or benefits to interfere with their decisions. This principle of loyalty entails avoiding any conflicts of interest that may arise. For example, a fiduciary must not engage in self-dealing or decision-making that benefits themselves at the expense of participants. Adhering to a strict code of ethics is vital to maintaining trust in the fiduciary relationship. The duty of diversification. A fiduciary must ensure that the investment lineup for a 401k plan is sufficiently diversified. Diversification protects against significant losses and spreads the investment risk across different asset classes. Fiduciaries should evaluate the asset allocation available in the plan and ensure that participants have access to various investment choices, including stocks, bonds, and mutual funds, that reflect an appropriate level of risk. If the investment plan permits participants to exercise control over assets, and they take advantage of this control, then fiduciaries are relieved from liability for the duty of diversification. Duty to follow plan documents. Fiduciaries are required to carry out their responsibilities in accordance with the governing documents and instruments of the plan, if such actions are consistent with ERISA regulations. These documents include, but are not limited to, the plan document, summary plan description, trust agreement, investment management agreements, and investment policies. It is crucial for fiduciaries to carefully review these documents to ensure that all decisions and actions are aligned with their provisions. A thorough understanding of these requirements is essential for maintaining compliance and effectively fulfilling their fiduciary duties. Duty of fee transparency and reasonableness. Fees associated with managing a plan can have a lasting impact on participants' retirement savings. Fiduciaries must scrutinize all service provider fees, investment management fees, and administrative costs. Transparency is crucial. Participants should be informed about what fees they pay and how these fees impact the growth of their accounts. Fiduciaries must use an objective process to ensure that fees are reasonable in comparison to the value of services provided. This process entails benchmarking a plan's fees versus comparable plans or industry averages and selecting plans accordingly. First, calculate the service provider fees and investment expenses for the plan. Second, compare these fees to the fees of 3 or more competing 401k providers. Employers should benchmark their 401k fees at least every 3 years. In recent years, lawsuits involving excessive fees against fiduciaries have become increasingly common and have resulted in judgments totaling tens of millions of dollars. Duty to communicate. Effective communication is a hallmark of responsible fiduciary practice. Fiduciaries must ensure that participants are kept informed about their investment options, the general state of the economy, and any changes that may affect their retirement savings. Additionally, providing educational resources empowers employees to make informed decisions about their investments. Workshops, webinars, or one-on-one consultations can support participants in better understanding their choices. Duty to compliance regulations. Navigating the regulatory landscape is another critical responsibility for fiduciaries. They must ensure the 401k plan complies with federal and state laws, especially the intricacies of ERISA. This includes fulfilling obligations for annual reporting and ensuring that the plan is operated according to its plan documents. Compliance helps mitigate the risk of legal challenges and enhances participants' confidence in the plan. Fiduciaries can delegate certain fiduciary duties to individuals who are not fiduciaries, but this delegation must be expressly permitted by the plan documents. The appropriate procedures for delegating fiduciary duties will be outlined in the plan documents. It's important to note that delegation itself is considered a fiduciary task. The named fiduciary must act prudently and in the best interests of plan participants and beneficiaries when selecting and monitoring the performance of those designated to carry out fiduciary responsibilities. When hiring a service provider for managing your retirement plan, it's important to keep in mind your fiduciary responsibilities. The easiest way to ensure compliance is to hire an investment manager, as defined by Section 338 of ERISA, to your account. These investment managers assume sole fiduciary responsibility and are held to an extremely high standard. Here are some key points to consider during the selection and monitoring of a service provider. Firm information. Review the firm's affiliations and financial condition. Check their experience, specifically with 401k plans. Consider the total assets they manage. Investment approach. Understand how the firm plans to invest plan assets or manage participant investment directions. Review their proposed fee structure. Professional qualifications. Investigate the identity and qualifications of the professionals managing the account. Inquire about any recent litigation or enforcement actions against the firm. Assess the firm's performance record and overall experience. Find out if the firm plans to collaborate with its affiliates for account management. Confirm whether the firm carries fiduciary liability insurance. Once a service provider is hired, ensure ongoing oversight by performance review. Regularly assess the provider's performance against benchmarks. Report evaluation. Thoroughly review any reports they submit regarding the management of the plan. Fee assessment. Verify the actual fees being charged against what was agreed upon. Policies and practices inquiry. Engage in discussions about their trading practices, investment turnover rates, and proxy voting policies. Participant feedback. Keep an ear out for any complaints from participants and follow up accordingly. By maintaining thorough documentation and monitoring practices, you can ensure the service provider remains in alignment with your plan's objectives and participant needs. The role of a 401k fiduciary is integral to the success of employee retirement plans. By fulfilling their responsibilities with diligence, prudence, and care, fiduciaries can help ensure that plan participants can effectively save for their future. Given the potential for legal repercussions and the significant consequences of mismanagement, it is crucial for fiduciaries to remain informed, act in good faith, and uphold the highest standards of fiduciary duty.